There's actually two ways that you can combine what we call a 121 exemption. That's that 250, $500,000 exemption in your primary residence with a 1031 exchange. So there's two different ways that you can combine the two and get the initial exemption and then the remainder deferred with your capital gains. So the first one we'll focus on is if you have a primary residence that you're looking to sell, ways that you can combine the two is if you have lived in it 2 of the last 5 years. So let's say you live in your primary residence, you move out and rent it out for 2 years. Now you've lived in it for 2 years, rented it out for 2 years. You can now combine that 121 and the 1031 to get the initial as a married couple $500,000 exemption and then defer doing a 1031 on the remainder of the capital gains. So that's a great tool, especially as you're looking towards maybe downsizing, retiring, even diversifying as your kids start to move out, ways to move out of your primary residence and start to look towards downsizing, or I just said that, retiring, and combining the 121 and the 1031 and not pay capital gains on all that equity that you've accrued after, owning your primary for decades.
So if I have $1 million of equity and I'm married, I automatically get the $500,000 exclusion. But by renting it for 2 years, and I think that's usually I know there's no hard, fast rule on this, but I think in general, you want to have at least two tax returns where you have a rental property, you actually are treating it like a rental property, you're collecting rent. You're separating it, you treat it as as a cash flowing asset. Then you go through and do the exchange. Then you can take the other $500,000 of gain and just keep deferring that just like it was a regular investment property.